When you open up your news feed right now, it feels a bit like looking at the dashboard of a car where the instruments are just completely at war with each other.
Yeah, it really does.
Right. Because on one side, the GPS is telling you that you're flying down this freshly paved highway straight toward some technological utopia. I mean, we're talking unstoppable artificial intelligence booms,
Yeah.
massive stock market highs that just keep breaking records week after week.
Momentum feels relentless.
Exactly. It feels like we are on the verge of a totally new industrial revolution.
It's a very compelling narrative, honestly, and it demands your attention because the numbers on the screen, the equity valuations, the sheer amount of capital flowing into tech,
Yeah.
they all seem to back it up.
But then you glance over at the fuel gauge.
Yeah.
And it's not just low, it is spinning backward, and the engine is making this terrifying deep grinding noise. You see, these massive headlines about global conflicts, shipping lanes being threatened, major geopolitical tensions. But then you look at what's actually happening at the gas pump or with global commodities,
Yeah.
and the prices are doing something completely bizarre.
We're dropping.
They're dropping, which reality is actually true. Like, are we booming? Or is the engine literally about to fall out of the car?
That contradiction, that is exactly what makes this specific deep dive so critical. We really have to look past the shiny objects of the daily news cycle.
So true.
Instead of just, reacting to the headlines, we have to look under the hood of global finance. We're going to connect the plumbing of the monetary system to global supply chains, to historical precedents, and ultimately to the hidden fragility of the entire global economy.
Okay, let's unpack this. Our mission today for you, the listener, is to decode that fragility. We want to understand the late-stage credit cycle we're currently living in by connecting these anomalies that seem, honestly, totally unrelated on the surface.
Absolutely unrelated to the untrained eye.
Yeah. So we're going to jump from falling oil prices to ghost cities in China to this wild currency experiment on the streets of Argentina, all to understand why the U.S. dollar is acting like a historical wrecking ball.
That's a perfect roadmap.
I want to start with the most visceral indicator of global economic health we have, which is energy, specifically the paradox of oil.
Energy is the economy. It is the lifeblood of everything we produce, transport, and consume. You really cannot separate economic growth from energy consumption.
Right.
So when oil behaves irrationally, you have to pay attention. It's the ultimate leading indicator.
So let's look at the timeline. During the recent crises in the Middle East, specifically when there were massive fears about the closing of the Straits of Hormuz, which is a massive choke point for global shipping,
A huge choke point.
oil spiked to about $120 a barrel. And the consensus at the time was that it was going to skyrocket to $150, maybe even $200 a barrel.
Right, and that expectation was based purely on the supply side of the equation.
Because everyone was panicking about supply cuts.
Exactly. Geopolitical instability in a major oil-producing region naturally threatens supply. When you have a potential bottleneck like the Straits of Hormuz, where roughly 20% of the world's daily oil consumption passes through...
20%.
Yeah, 20%. Any threat to that passage logically dictates a massive price premium.
But that is not what happened. Instead of rocketing to $200, prices plummeted. They dropped all the way down into the $60 range over the following months.
Which completely broke the standard forecasting models.
And to make it even more confusing, we can look at a very specific recent event. The U.S. government revoked licenses authorizing Iranian oil sales. Now, objectively, taking Iranian oil off the market creates a tighter global supply.
It physically restricts the amount of crude available to buyers.
Right. And yes, that news triggered a brief, 3% spike in Brent and WTI crude.
Which are the two major global pricing benchmarks for oil, just to clarify for everyone.
Good point, yeah.
Brent crude is the benchmark for the broader global market, primarily oil from the North Sea, while WTI West Texas Intermediate is the benchmark for U.S. domestic oil.
Right, so both of those benchmarks saw a tiny little 3% bump when the Iranian supply was restricted. But the overarching long-term trend remained shockingly low. It just kept grinding downward.
Because the market has this absolute obsession with supply while entirely ignoring demand.
Ignoring demand.
Completely. If you have a situation where supply is demonstrably tight, or at least facing severe quantifiable geopolitical risks, and yet prices are still in a free fall, There is only one mathematical conclusion.
Demand must be falling even faster than supply is tightening.
Exactly.
Hey, let me make sure I'm really following the logic there. Even with the Middle East in turmoil and Iranian oil restricted, the price drops because nobody actually wants to buy it.
Well, it's not that they don't want to buy it, it's that they do not have the economic capacity or the industrial need to buy it.
Oh, wow.
If demand for oil is falling, it signals a massive global economic slowdown. Think about the physical mechanics of the global economy. If factories and manufacturing hubs aren't running at full capacity, they use less power.
Makes sense.
If goods aren't being manufactured, they aren't being loaded onto massive cargo ships. And those ships burn massive amounts of bunker fuel, which is a petroleum product.
So the whole chain just stops.
Right. If consumers aren't buying physical products, the entire logistical chain that requires energy to move those products simply powers down.
I love trying to visualize this. It's like, imagine a highly anticipated, massive stadium concert.
Oh, okay, I'm picturing it.
The promoters suddenly announce they are cutting the number of available tickets in half because they closed off the upper decks. Normally, you'd expect the price of those remaining tickets to absolutely skyrocket on the secondary market.
Sure, basic scarcity.
But instead, you go outside the venue, and the scalpers are literally dropping their prices, practically begging people to take the tickets, and they still can't get rid of them.
Yes. The supply of tickets is restricted, just like the supply of oil, but the price is dropping.
Which means the fans aren't just broke. They have left town entirely. Nobody is showing up to the venue.
The demand has evaporated. And in the context of the global economy, we have to track where that demand went, or rather, where it disappeared from.
Right.
And that leads us directly to the world's second largest economy, which has historically been the primary driver of global commodities demand.
China.
Precisely. The data highlights a staggering shift. China has essentially stopped buying oil at their previous historical rates.
Wow.
For the better part of 2 decades, China was the engine of global commodity consumption. They were building megacities, high-speed rail networks, and just massive industrial zones.
But to understand why their energy consumption has fallen off a cliff, we really have to look at the biggest asset class on Earth.
Yes, we do.
Okay, so the biggest asset class on Earth. When people hear that phrase, they probably think of the U.S. stock market or maybe U.S. residential real estate.
That's the natural assumption for most Western investors.
But looking at the historical data, prior to its recent crash, Chinese real estate was the largest single asset class in the world. Bigger than our stock market, bigger than our housing market. We are talking about tens of trillions of dollars in paper wealth.
It was an absolute economic monolith. It wasn't just a place for people to live, you know.
Yeah.
It was the primary vehicle for wealth generation and savings for the emerging Chinese middle class.
Right.
And right now, China is suffering through what can only be described as a great financial crisis of their own.
And the numbers are terrifying. I mean, they have essentially erased all the gains from the last 20 years. Real estate prices in major markets have dropped an estimated 50 to 60% from their all-time highs.
It's a staggering destruction of wealth.
Now, there is some political context to this crash. A few years ago, the Chinese leadership introduced a policy directive centered around the slogan, "Houses are for living, not for speculation."
Right, that phrase was a deliberate top-down mandate. The goal was to curb the excessive, rampant speculation that had inflated this massive real estate bubble.
So they popped their own bubble on purpose.
They wanted to deleverage the property developers and cool the market to prevent a systemic collapse later on. But if we look at this purely from an economic perspective, reporting impartially on the outcome of that policy, regardless of the political intent, the result has been a catastrophic deflation of value.
Because you can't really control a crash once it starts.
Exactly. You cannot deflate a bubble of that magnitude safely.
Here's where it gets really interesting, though. If the single largest asset class in the entire world just halved in value, losing 2 decades of wealth, why aren't we seeing total apocalyptic global panic right now?
That is the million-dollar question.
Right. To put it in perspective for you, the listener, imagine if you woke up tomorrow and U.S. home prices had reverted to what they were in 2004, like a 50% haircut overnight.
If that happened in the U.S., the economy would be entirely decimated. Consumer spending would freeze instantly, the banking sector would be insolvent. You'd see a cascading series of defaults across the entire financial system.
So why is it so quiet with China's crash?
To answer your question about why we aren't seeing headline panic regarding China's crash, it's because the contagion is moving through the plumbing of the global financial system.
The plumbing.
Yes, which is largely invisible to the average observer until the pipes actually burst.
I want to dig into that. What exactly does the plumbing look like in this scenario? How does a half-finished apartment building in Shenzhen affect a bank in Tokyo or New York?
You have to look at the mechanics of international lending and fractional reserve banking. The Chinese property developers who built this massive real estate market, these massive conglomerates, they didn't just borrow Chinese yuan from domestic banks to fund their operations.
Oh, they didn't.
No, they borrowed heavily on the international market, specifically in U.S. dollars.
Wait, why borrow in dollars instead of their own currency?
Because the U.S. dollar market has the deepest liquidity and historically offered very attractive interest rates for emerging market corporate debt. So these developers issued massive amounts of dollar-denominated bonds.
Okay, I see.
And the institutions buying those bonds, effectively lending them the dollars, were often Japanese banks, European pension funds, and other international financial institutions.
Okay, I totally see where this is going now. So Japanese banks have these massive loans sitting on their balance sheets, lent in U.S. dollars, to Chinese real estate giants.
Yes.
And the collateral for those loans, the actual real estate, is now worth half of what it was when the loan was underwritten.
That is the core of the issue. When a Chinese developer defaults on a dollar-denominated loan, or even if the value of their bonds just plummets in the secondary market, it severely damages the balance sheet of the Japanese bank holding that debt.
Because the asset on their ledger is suddenly toxic.
Precisely. In a fractional reserve banking system, a bank's ability to lend is dictated by the health of its balance sheet. When a bank takes a massive hit to its assets, they do not just shrug it off and keep doing business as usual.
Right, they panic.
They are forced by regulators and by their own risk management protocols to shore up their capital reserves.
Meaning they pull back on lending everywhere else.
They pull back hard. They stop issuing new loans to mid-sized businesses in Japan or Europe. They tighten credit requirements. They might even call in existing lines of credit if the covenants allow for it.
Wow.
This process quietly chokes off the circulation of money and credit globally. So China's real estate crash is not an isolated, localized event.
Right, it's bleeding out.
Through the mechanisms of international dollar debt, it acts as a massive drain on global liquidity, freezing up the gears of international finance.
So global demand has left town because China is in a silent financial crisis, which is freezing up international bank lending through this invisible plumbing.
That's a perfect summary.
That leaves the global economy supposedly relying on the one engine left, which is the United States. But based on the macroeconomic data, we have to ask, is the U.S. engine actually running? Or is it just running on fumes and the hype of artificial intelligence?
That is the multi-trillion-dollar question defining the current market. The data suggests that the U.S. economic growth we're seeing is highly concentrated.
Concentrated how?
It's propped up almost entirely by two pillars: inflated asset prices and AI CapEx.
CapEx being capital expenditure, the billions and billions of dollars being spent by tech giants on servers, specialized microchips, and massive data centers.
Exactly. The sheer scale of the investment is staggering. But underneath those two pillars, there is a structural rot in the credit markets that people are largely ignoring because they're distracted by the geopolitical headlines and the booming stock market.
Let's talk about that rot, because the research points to a very specific monster hiding under the bed of the U.S. economy: private credit.
Ah, yes. Private.
It's often referred to as the new subprime, and we are talking about a $3 trillion market.
To give you some context on how this works, private credit involves lending by non-bank institutions. Following the 2008 financial crisis, traditional banks like J.P. Morgan or Bank of America were hit with massive new regulations.
Dodd-Frank and all that.
Right. Those regulations heavily restricted their ability to make risky loans, but the demand for those loans didn't just disappear.
Where did it go?
It just moved into the shadow banking sector.
And so instead of a regulated bank giving a loan, it's a private equity firm, a hedge fund, or a specialized credit fund lending directly to businesses or consumers.
Exactly. They step in to fund the deals that are too risky or too highly leveraged for traditional banks. And this $3 trillion ecosystem includes some very volatile sectors.
Like what?
Subprime auto loans, highly leveraged multifamily real estate projects, and distressed commercial real estate.
Now, I know what some skeptics are going to say, because I hear this argument all the time. People look at that number and say, $3 trillion, who cares? The mortgage market in 2008 was roughly $60 trillion.
Right, they see it as a drop in the bucket.
Yeah, they say $3 trillion is a rounding error. It's a nothing burger compared to the overall economy. How does the historical data respond to that dismissal?
It responds by demanding we look at how the monetary system actually functions.
Okay, unpack that for us.
The financial system does not function purely on an absolute tally of dollars. It is not just a giant calculator. It functions entirely on psychology, confidence, and counterparty risk.
Counterparty risk. Let's break that concept down for a second because it comes up a lot.
Counterparty risk is simply the risk that the person or institution on the other side of a financial transaction might not pay you back or might not be able to fulfill their contractual obligation.
So if I trade with you, my risk is that you go bankrupt before the trade actually settles.
Exactly. To illustrate why absolute dollar amounts matter way less than psychology, let's look at a brilliant historical anchor from the 2008 Great Financial Crisis.
Oh, this is a great comparison.
When the entire global system almost collapsed, when Lehman Brothers fell, what do you think the actual default rate on those underlying residential mortgages was?
Honestly, if you ask the average person on the street who lived through 2008, they'd probably assume half of all homeowners in America stopped paying their mortgages.
That's certainly how it felt.
Yeah, they'd guess 40 or 50% defaults, given how completely apocalyptic the fallout was.
That is how big the panic felt. But the mathematical reality, the actual default rate only rose from a historical baseline of about 1 or 2% up to roughly 5 or 6%. That is it.
Wait, really?
Yes, a roughly 4% change in the default rate on the underlying asset.
Wow. Just a 4% shift in defaults caused the entire 2008 meltdown. That honestly seems impossible.
It happened because that tiny shift in actual defaults completely shattered the psychology of the market. These mortgages were bundled into complex derivatives, and those derivatives were sitting on the balance sheets of every major bank in the world.
Right, the toxic assets.
When defaults hit 5%, the value of those derivatives became highly questionable. Suddenly, Bank A didn't know if Bank B was holding billions in those toxic assets.
So the counterparty risk went through the roof.
Exactly. Trust vanished overnight. And when trust vanishes in a credit-based system, liquidity instantly dries up. Banks stop lending to each other entirely because they are terrified the other bank is insolvent.
So they hoard cash.
Yes. And the exact same psychological panic can happen with a $3 trillion private credit blowup as a $60 trillion mortgage blowup. It is not about the size of the underlying loan pool.
It's about the fear.
It's about the sudden loss of confidence that triggers a systemic liquidity freeze.
And we are already seeing the cracks in the dam in the private credit space, aren't we? The research specifically mentions major players like Blackstone starting to gate their private credit funds.
Yes, and gating a fund is a massive red flag.
Explain the mechanics of that. What does it actually mean for an investor when a fund is gated?
Imagine you invest $100,000 in a private credit fund. You assume you can withdraw your money, or at least a portion of it, on a regular schedule, maybe quarterly.
Because it's my money.
Right. But if the fund is heavily invested in illiquid assets like distressed commercial real estate, and suddenly too many investors ask for their money back at the exact same time, the fund doesn't have the cash on hand.
Uh-oh.
To prevent a forced fire sale of their assets, the fund manager gates the fund. They legally restrict investors from withdrawing their money.
They just lock the doors.
Exactly. You only pull that lever if you are facing a severe liquidity crunch and the threat of a bank run on your fund.
That is terrifying for the investors. But the cracks extend beyond just the private credit space, right?
Yeah.
They're also showing up in the one pillar supposedly holding the whole U.S. economy up, the AI boom.
This is a fascinating data point. We're seeing massive firms starting to back out of previously planned AI data center deals.
Really?
Yes. And the reason given isn't a lack of capital, it's excess capacity. The analysis specifically points to Meta, Facebook's parent company, suddenly realizing they have excess compute capacity.
Which is a stunning reversal. Just a few months ago, the entire market narrative was that Meta was desperately behind in the AI arms race.
That was the consensus.
The narrative was that they needed infinite compute power, infinite servers, and that their CapEx spending would just scale up indefinitely.
This sudden pivot to having excess capacity suggests a few possibilities. Either their engineering became incredibly efficient overnight, which is highly unlikely, or the demand for the actual consumer output of these AI investments isn't matching the speculative hype.
So they built too many data centers.
The infrastructure may have been massively overbuilt in a frenzy to not be left behind. If that CapEx spending slows down, you lose one of the primary drivers of current U.S. GDP growth.
Okay, so corporate investment might be stalling out. But if you look past the corporate level down to the average worker, The reality of the U.S. economy gets even darker.
It really does.
We constantly hear these headline numbers on the news about job growth. But when you dig into the discrepancy between the different labor surveys, the picture changes entirely. Let's unpack the non-farm payrolls versus the household survey.
This is crucial for understanding the true health of the consumer. The headline number you see on the news is usually from the establishment survey, commonly known as non-farm payrolls.
Okay.
This survey asks businesses how many people are on their payroll.
Right. And recently, that non-farm payroll number missed expectations by roughly 57,000 jobs. The market expected a certain amount of growth, and it came in slightly under. Not great, but hardly a disaster. Right?
On the surface, yes, but you have to contrast that with the household survey. The household survey doesn't ask businesses. It calls up individual households and asks the people living there, are you currently employed?
Why does the difference in methodology matter so much?
Because of how multiple jobs are counted.
Oh, I see where this is going.
If one individual is struggling to make ends meet and has to take on 3 separate part-time jobs, the establishment survey the businesses reports 3 jobs created.
Right, because 3 different companies are issuing a paycheck.
Exactly. But the household survey talks to that one person, and they report as one employed individual.
Ah, so the headline number can look great if people are just taking on second and third gig economy jobs to survive inflation. But what did the recent household survey actually show about total employment?
It showed that the actual number of employed people in the United States dropped by over 500,000 in a single month.
500,000 people losing their employment status in 1 month, while the headline number just says missed by 57,000. That is a massive divergence.
It vividly illustrates the fragility underneath the surface. The underlying economy is not running on all 8 cylinders. It's barely running on 4.
Yeah.
And yet everyone is distracted by the shiny object of AI and geopolitical conflict, completely ignoring the structural rot in the labor market and credit system right here at home.
So for you, listening to this deep dive right now, the logical question you're probably asking is, if the underlying economy is this fragile, if China is suffering a silent financial crisis, if private credit is cracking, if the AI boom is showing signs of stalling, and 500,000 employed people vanished in a month, how on earth is the stock market still standing?
It's the ultimate disconnect.
How are we still seeing near record highs in the major indices?
To answer that, we have to look at a very rare historical market indicator to understand the current risk and then explain the underlying mechanical force that is currently keeping the floor from falling out.
Okay, let's look at the indicator first.
Right. This specific indicator dates back to 1971. It tracks the behavior of the Dow Jones Industrial Average relative to the NASDAQ.
The premise of the indicator is based on capital rotation, right?
Exactly. If you see a divergence of more than 5% between the Dow and the NASDAQ within a very compressed time frame, specifically a 7 to 10 trading day period, it signals severe underlying market stress.
Give me an example of what that actually looks like on the trading floor.
It looks like institutional capital aggressively fleeing risk. If investors are terrified of a sudden economic shock, they will aggressively sell off their high-flying, highly valued tech stocks in the NASDAQ.
The dumping the risky stuff.
Yes. But they don't just go to cash. They rotate that capital into the perceived safety of traditional dividend-paying blue-chip stocks in the Dow Jones. They are seeking a safe harbor.
And the data shows that when this specific 5% divergence triggers in such a short window, historically, there's a 67% probability of a major bear market occurring in both indices shortly after.
It's a massive historical warning light. You are watching the smart money desperately repositioning. The last time a trigger of this exact magnitude occurred was right at the absolute peak of the dot-com bubble.
And we know exactly how that ended.
It was brutal.
The NASDAQ subsequently dropped 80% from its highs, and the broader S&P 500 dropped 40 to 45%. So what does this all mean for us today? If the historical warning lights are flashing red and the economic fundamentals we just discussed are rotting, why hasn't the market collapsed yet? What is holding it up?
The answer lies in the safety net of passive investing.
Passive investing. We're talking about index funds, standard 401ks, target date retirement funds.
Exactly. For the last 25 years, the dominant psychological and structural force in the U.S. equity market has been the buy the dip mentality.
Right.
Millions of American workers automatically funnel a portion of their paycheck into the S&P 500 every 2 weeks, completely blind to the actual valuation of the companies they are buying.
It's totally mechanical. It doesn't matter if Apple's price-to-earnings ratio is at 10 or at 50. The 401k contribution just buys the index regardless.
This creates a massive, relentless inflow of capital. Trillions of dollars just mechanically entering the market every single month. This constant bid acts as a counterbalance to any fundamental economic slowdown.
It's like a shock absorber.
It creates an artificial floor under the stock market, absorbing the sell-offs from active managers.
But there is a terrifying tripwire for that safety net. It's not an invincible floor.
No, it is highly dangerously dependent on the labor market. The models we are looking at focus on the unemployment rate to find the breaking point. The critical question is, at what point does that massive passive inflow of capital structurally turn into a massive passive outflow?
Because if you lose your job, the very first thing that happens is your biweekly 401k contribution stops. The inflow halts.
Immediately.
And if you're unemployed for long enough, you actually have to start withdrawing from your retirement accounts just to buy groceries, pay your mortgage, and survive.
Precisely. You go from being a blind mechanical buyer to a forced mechanical seller. And the model tripwire for that systemic reversal is roughly when the official unemployment rate hits the 5.5% to 6% threshold.
So if the true labor market deterioration, like that 500,000 drop in the household survey we talked about earlier, eventually bleeds into the headline unemployment number and pushes it towards 6%, the entire machine goes into reverse.
The relentless price-insensitive buying becomes relentless price-insensitive selling. And because the market is so heavily concentrated in these passive vehicles, when that flow reverses, the artificial floor completely drops out.
And then what?
The market has to rapidly reprice based on actual economic fundamentals, which, as we've established, are incredibly weak.
Wow.
Yeah.
Okay, so put yourself in the shoes of an investor right now. You're looking at a global slowdown, a silent crisis in China, a potential private credit blowup, and a stock market that is essentially one really bad unemployment report away from a mechanical systemic sell-off.
It's a daunting environment.
Where do you go? When equities look like a coin toss at best, where does the smart money look to survive a late-stage credit cycle?
Historically, in this specific macro environment, investors pivot toward commodities, specifically precious metals like gold and silver. But we have to have a very nuanced conversation about why they have value right now, because the mainstream narrative is often slightly misleading.
Let's start with gold. If you turn on any financial news network, the standard line is that gold is the ultimate inflation hedge.
And over very long, multi-decade timelines, it generally maintains purchasing power. But the data shows that gold can actually underperform inflation for remarkably long stretches.
Really?
Oh, absolutely. You can easily find 2, 3, or even 5-year periods where inflation is running hot and the price of gold is actually going down, completely contradicting the mainstream narrative.
Right. So if it's not just a simple one-to-one inflation hedge, what is the core mechanical driver for gold? Why do central banks and massive institutions hold it?
Its true structural value, especially in the environment we've been describing, is as a hedge against counterparty risk.
There's that term again, counterparty risk.
Gold is the one major financial asset that is not simultaneously someone else's liability. Think about it. A U.S. Treasury bond is a promise by the U.S. government to pay you back.
Right.
A corporate bond is a promise from a company. Even the cash in your bank account is technically a liability of the bank. They owe you that money.
But physical gold doesn't rely on a promise.
Exactly. When trust in the monetary system breaks down, or when geopolitical risk spikes to the point where nations don't trust each other's debt, gold consistently catches a massive bid.
Because it's tangible.
Yes. Central banks around the world, particularly in emerging markets, are buying gold right now at record paces, precisely because they want reserves that aren't reliant on the promises of another nation, particularly the United States.
But while gold is the classic safety play, the analysis we are looking at is actually much more fascinated by silver right now. They frame it as a more speculative but potentially explosive play.
Yes, and this is based on a specific technical charting theory credited to a macro analyst named Hugh Henry.
Yeah.
The theory posits a psychological and mechanical relationship between time and price breakouts. The core idea is that the longer an asset takes to return to a preceding all-time high, the more powerful and explosive the breakout will be once it finally crosses that threshold.
I love this concept. It makes intuitive sense. It's like a coiled spring.
Perfect analogy.
If a market spends years trying to break through a certain price ceiling and failing, there is a massive buildup of psychological resistance. But once it finally breaks through, All the short sellers have to cover, the momentum algorithms kick in, and it stores up massive kinetic energy for the release. Let's look at the timeline for silver to see how this applies.
Silver hit a major historic high back in 2011, reaching roughly $50 an ounce. And it has spent well over a decade languishing below that mark, building up that theoretical energy.
And now?
Recently, it has started to break back up toward those levels, though it remains highly volatile.
So what is the actionable insight here?
The analysis suggests that if the global economic slowdown we've been discussing causes a broad market sell-off that drags the price of silver back down into the lower ranges temporarily, it would represent a massive historical buying opportunity.
Because of the coiled spring.
Because the long-term setup, the coiled spring aiming for that $50 breakout, remains incredibly potent based on this multi-decade charting theory.
And to really drive this point home about the power of long-term charts and market psychology, the research compares this setup to the Nikkei index in Japan.
The Nikkei is a perfect example of how long these cycles can take. The Japanese stock market hit its absolute peak during their massive asset bubble back in 1989 and 1990.
Right.
And it took 35 years, from 1990 all the way to 2024 and 2025, for that index to finally claw its way back and exceed its previous high.
35 years just to break even on a nominal basis? That kind of timeline requires immense patience and, frankly, an iron stomach. But it completely validates the underlying theory of how long-term market psychology handles massive historical resistance levels. Once the Nikkei finally broke its 1990 high, it saw a massive surge of momentum.
It is a vital reminder about the time frame of true macro investing. We are so conditioned by modern trading apps to expect instant gratification, checking our portfolios on our phones every hour.
Absolutely guilty of that.
But these fundamental macroeconomic cycles can take decades to play out.
However, we've talked about stocks, we've talked about the private credit markets, we've talked about commodities like oil, gold, and silver. But every single one of these things, every asset, every barrel of oil, every ounce of gold is ultimately priced and measured against one single foundation.
The U.S. dollar.
The U.S. dollar. And right now, the data paints a picture of the dollar behaving like a historical pirate.
This brings us to one of the most compelling and terrifying analogies in the entire analysis. The concept of the dollar wrecking ball.
The wrecking ball?
Yes. To understand how the U.S. dollar can fundamentally destroy global economies while simultaneously getting stronger, we have to look at the mechanical trap that countries like Japan are caught in.
Okay, let's walk through the Japan death spiral step by step, because this perfectly illustrates the mechanics of the global reserve currency. Japan is an island nation. They have a massive, highly advanced industrial economy, but they have almost zero domestic energy resources.
Right, they have to import it all.
They have to import almost all of their oil and natural gas. And crucially, on the global market, commodities like oil are priced exclusively in U.S. dollars.
This is the inescapable reality for the vast majority of the world. To keep their factories running and their cities lit, Japan must buy oil. To buy that oil on the global market, they need U.S. dollars.
So what do?
The Bank of Japan, or Japanese corporations, have to constantly sell their own domestic currency, the yen, into the foreign exchange market in order to buy the dollars they need to purchase the energy.
So they are constantly dumping yen and buying dollars. The basic law of supply and demand dictates what happens next. The supply of yen on the open market goes up, so its value drops.
Exactly.
The demand for dollars goes up, so its value rises. And this relentless mechanical pressure has decimated the yen, pushing it down to exchange levels recently not seen since 1986. But how does this become an inescapable death spiral?
Because the weaker the yen gets against the dollar, the more yen Japan has to sell to afford the exact same barrel of oil.
No.
It's a compounding mathematical trap. If the exchange rate worsens by 20%, their energy costs go up by 20% in local currency terms, forcing them to print or sell even more yen.
Now, historically, a country offsets this currency drain by exporting goods, right? We'll use Toyota as the classic proxy. Japan manufactures Toyotas, ships them across the ocean, and sells them to the United States.
Yes, that's the standard model.
In return, they earn U.S. dollars naturally from American consumers. They can then use those earned dollars to buy their oil, protecting the yen from having to be sold on the open exchange.
That is how the system functions in a healthy, expanding global economy. But if we connect this to the very first thing we talked about, falling oil demand, signaling a severe global economic slowdown, what happens to Toyota sales?
If the global economy slows down, the U.S. consumer feels the pinch. They delay buying a new car, Toyota sells fewer vehicles in the U.S.
Exactly. And when Toyota sells fewer cars, Japan's natural, organic inflow of U.S. dollars dries up. But their population still needs electricity, they still need the oil.
So they have no choice.
Right. Without those export dollars coming in, they are forced to go back to the foreign exchange market and sell even more yen to get the dollars they desperately need to survive, accelerating the violent collapse of their own currency.
It's terrifying. It's a literal doom loop. And what do the central planners in Japan do? The Bank of Japan can't just sit there and let their currency hyperinflate to zero.
They are forced to intervene directly in the currency markets. The Bank of Japan has to take their sovereign foreign exchange reserves, which are mostly massive hoards of U.S. Treasury bonds, and they have to sell those U.S. Treasuries on the open market to get cash dollars.
Just to prop up the yen.
Yes, they use those dollars to buy back their own yen, artificially propping up its value.
But those reserves, as massive as they are finite. You can only burn through your savings account for so long before you are completely defenseless against the market.
And it gets worse. Selling U.S. Treasuries drives up U.S. interest rates, which perversely can make the dollar even stronger, compounding the problem further. It is a no-win scenario.
This raises an incredibly important question for anyone looking at the global stage. If this dollar value system is so structurally destructive to other sovereign nations, why on earth do they tolerate it? Why don't they just opt out? And this is where the research drops that incredible historical analogy about the Sea Peoples.
I love this analogy. To understand the sheer destructive dominance of the dollar, we travel back to the late Bronze Age, roughly 1200 BC. The dominant, unassailable global superpower of the era is the Egyptian Empire.
The big guys on the block.
Right, and suddenly these mysterious, highly aggressive maritime raiders appear in the historical record, known only as the Sea Peoples. They were essentially ancient, heavily armed pirates.
And they were utterly ruthless. The historical record shows how they swept from the Mediterranean near Italy all the way down the coast toward Egypt, systematically destroying everything in their path.
They burned everything.
They pillaged the major coastal cities and burned the trade hubs, took the gold, and wrecked shop.
But when they finally reached the borders of Egypt, Pharaoh Ramses III, who was a brilliant military tactician, was waiting for them.
He was ready.
He managed to lure the Sea People's fleet into the shallow, treacherous waters of the Nile River Delta. He trapped them, his archers decimated their ships, and he decisively defeated them. Egypt won the war.
They won. They defeated the unstoppable pirate menace. Ramses built massive monuments to celebrate the victory. But the Egyptian Empire collapsed shortly after anyway. The Bronze Age collapse consumed them.
Why?
Because the Sea Peoples didn't actually have to defeat the Egyptian military to destroy the Egyptian economy.
Wow.
On their violent path down to Egypt, the Sea Peoples had systematically burned and destroyed all of Egypt's major trading partners. The cities they sacked in the Levant and Anatolia were the very cities Egypt relied on for their vital exports and imports.
So they were isolated.
Even though Egypt survived the physical battle, they had no one left to trade with. Their economy imploded from complete systemic isolation. And the macroeconomic analysis applies this directly to the mechanics of the U.S. dollar today. The U.S. dollar is the modern-day Sea Peoples. It is so relentlessly strong, and the need for it is so absolute that it is crushing the economies of U.S. trade partners.
It's acting just like those pirates.
The data highlights nations like Japan, India, Indonesia, and South Korea. The relentless strength of the dollar is wrecking their domestic currencies and importing massive inflation into their economies.
The profound irony here, the historical parallel, is that the United States is currently playing both roles in this drama. We are the pharaoh, the dominant, unassailable empire, but we are also the creator, the backer, and the beneficiary of the pirates.
We are our own worst enemy.
Our own currency is systematically destroying the economic health of the global trade network that we ultimately rely on to sustain our own economy. If Japan and Europe are economically crushed by the strong dollar, who's going to buy American debt or American software?
But wait, this brings me back to my earlier question. If countries realize they are being pillaged by the dollar, why don't they just stop using it? We hear about de-dollarization constantly in the financial press.
Constantly.
Countries supposedly setting up new trading blocks, bilateral trade agreements in local currencies, or moving to a gold standard. To answer this, the research takes us out of the macroeconomic clouds and brings it down to the actual gritty reality of the streets with one of the most mind-bending firsthand anecdotes I have ever heard.
This is the ultimate reality check against all the theoretical ivory tower arguments about gold or cryptocurrencies suddenly replacing the dollar.
So tell us the story.
The analyst recounts a first-hand experiment of traveling across Argentina during a period of intense, catastrophic economic crisis.
Right. Argentina is the perfect test tube for this. Their currency, the peso, was depreciating at a staggering rate of roughly 20% per month. Hyperinflation in real time.
It was a complete meltdown.
So the analysts decided to do an experiment drive across the country and try to survive, pay for hotels, food, and goods, using only theoretically hard assets.
Yeah.
Physical gold, silver coins, and Bitcoin. Absolutely no US dollars allowed.
Theoretically, according to every textbook on monetary theory, in a hyperinflationary environment where the government currency is melting like ice in the sun, those are exactly the assets citizens should be begging for.
Right. They are decentralized, they are independent of the failing government, and they have historically been the ultimate stores of value during a crisis.
But the reality on the ground was completely, shockingly upside down. The analyst goes to jewelers, to tech shops, to university campuses, trying to trade solid gold coins, silver, and Bitcoin for local goods.
Or even just trying to exchange them for the rapidly depreciating local pesos so he could buy dinner.
And the result, absolutely no one wanted them.
It's a stunning repudiation of traditional hard money theory. When he tried to sell universally recognized gold coins, professional jewelers either flat out refused the transaction, or they demanded a predatory 50% haircut on the spot price.
They simply didn't want the risk or the hassle of holding the physical metal.
And the silver. This was the craziest part to me. He found that silver coins were actually the easiest of the three to sell, but not because the locals value this silver metal as a financial hedge against inflation.
No, not at all.
They bought the coins strictly for their novelty, as a cool collectible. They didn't care about the intrinsic metallic value or the spot price of silver at all.
Meanwhile, what did every single person in Argentina desperately, uniformly want? They wanted the US dollar. Or, shockingly, they even preferred their own rapidly collapsing local peso over the gold or the Bitcoin.
Why? I have to push back here, because logically, if your local currency is losing a fifth of its purchasing power every 30 days, why on earth would you choose to hold that over a physical ounce of gold?
What's fascinating here, and what explains the absolute dominance of the dollar, is the triumph of the network effect over the theoretical concept of a store of value.
The network effect. Let's unpack the mechanics of that.
Money is fundamentally a technology of communication. It is only useful if other people readily accept it without friction. The analysis compares the US dollar to the Apple iPhone and compares everything else, gold, Bitcoin, local fiat currencies, to a standard flip phone.
A flip phone is totally fine. It makes phone calls. The battery lasts a week. You might even be more durable if you drop it. But it's not an iPhone.
Exactly. What makes the iPhone superior, what makes it dominate the market, isn't just the physical glass and metal. It's the app ecosystem. It's the incredibly dense network of developers, users, and integrated services.
The network is the value.
You don't use the US dollar really because it perfectly holds its value. In fact, we know inflation constantly erodes its purchasing power. You use the dollar because it has the apps.
And in global financial terms, what exactly are those apps?
The apps are the massive, deeply entrenched global infrastructure built exclusively around the dollar. It's the multi-trillion-dollar interest rate swap markets. It's the complex derivatives clearinghouses.
On the plumbing we talked about earlier.
Exactly. It is the deep, instantaneous global liquidity where you can move $10 billion at 2 a.m. on a Sunday. If a massive multinational corporation in Japan needs to hedge $1 billion of currency risk by tomorrow morning to make payroll, they can only execute a trade of that size in the US dollar network.
Because nowhere else can handle it.
No other currency system on Earth has the depth, the regulatory framework, or the financial tools to handle it. You cannot dethrone the dollar unless you provide a system that isn't just as good as a store of value, but a system that is 100 times better with all the exact same utility and infrastructure ready to go on day one. And that simply does not exist.
So the network effect effectively traps everyone in the dollar system, even as it wrecks their local economies. But I want to introduce a different perspective here on behalf of the listener, because there's a very loud, ongoing political and economic debate happening in the U.S. right now.
Let's hear it.
People look at the loss of American manufacturing, the Rust Belt, and they argue that deglobalization is the answer. The argument is that the U.S. actually needs a weak dollar.
I've heard this argument frequently.
The theory is that if we artificially weaken the dollar, it makes American exports cheaper for the rest of the world to buy, and that will miraculously bring all those factories and manufacturing jobs back home. The research addresses this specific macroeconomic theory, right?
Yes, and we must examine this strictly through an impartial economic and historical lens, setting aside the political rhetoric. Some economic data suggests an alternative perspective to the weak dollar theory.
What does the data say?
The analysis points out that currency valuation is only one variable in corporate decision-making, and it is vastly outweighed by the need for regulatory certainty and long-term stability.
Explain that logic, because on paper, if the dollar is weak, labor and production costs in the U.S. look cheaper to a foreign buyer. That should incentivize a company to build a factory in Ohio instead of overseas, shouldn't it?
The flaw in that logic is the time frame of capital allocation. You do not commit $5 billion to build a massive state-of-the-art semiconductor manufacturing plant based on today's fluctuating currency exchange rate.
Right.
You build that factory based on a 10, 20, or 30-year projection of profitability.
Right, because it takes 5 years just to build the thing before it produces a single microchip.
Exactly. And if a multinational corporation does not know what the tax structure will be, what the environmental regulations will demand, what the labor laws will dictate, or what the energy costs will look like in 10 years, they simply will not deploy the capital, regardless of how incredibly weak or advantageous the domestic currency might be at this exact moment.
Right. Capital requires long-term certainty, far more than it requires a temporary currency discount.
The analysis uses Argentina again as the perfect real-world counterexample. Argentina has an incredibly weak, constantly depreciating currency. By the strict, weak currency brings manufacturing logic, international corporations should be flocking to Argentina to build factories and take advantage of the dirt-cheap exchange rate.
They should be an industrial powerhouse.
But they aren't. Foreign direct investment there is minimal because corporations are stifled by regulatory burdens, shifting tax codes, and extreme political and economic uncertainty. You cannot build a 30-year supply chain on top of shifting sand.
Okay, so we have this unstoppable dollar wrecking ball armed with an unbeatable network effect, acting like the sea peoples and systematically destroying global trade partners. And we are sitting in the late stages of a massive global credit cycle, ticking every historical box for a major economic contraction from China's real estate collapse to the cracks in U.S. private credit.
We are in the thick of it.
Which brings us to the endgame. The research describes a terrifying mechanical outcome of all this debt unwinding, the dreaded concept of the dollar crashing up.
This is perhaps the most counterintuitive and dangerous concept in the entire macroeconomic analysis. To understand it, we have to understand how money is actually created in the modern era.
Right.
When the global economy is booming and expanding, massive amounts of debt are created. And in a fractional reserve system, dollars are literally lent into existence.
So when a bank issues $1 billion loan for a new skyscraper, they don't just take $1 billion out of a vault. They essentially create that money digitally, expanding the total supply of dollars in the world.
Correct. Credit creation is money creation. But the terrifying inverse is also true.
When the debt goes bad.
Yes. When that global credit cycle contracts, when the skyscraper project fails and defaults, or when corporations aggressively pay down their debt to survive a recession, those dollars are literally extinguished from the financial system. They disappear from the ledger. So as the global economy slows down and massive amounts of debt are rapidly unwound or defaulted on, the actual physical supply of U.S. dollars circulating in the global banking system begins to rapidly shrink.
And basic economics kicks in. Less supply of dollars against a constant or rising demand to service remaining debts means a higher price. The dollar gets stronger.
It gets stronger precisely at the worst possible moment. Just when foreign countries like Japan or emerging markets are most desperate to acquire dollars to pay for their vital energy imports and service their own dollar-denominated corporate debts, the supply vanishes.
So they're scrambling for something that isn't there.
This creates an aggressive global short squeeze on the reserve currency. The dollar doesn't crash down in value, it crashes upward, violently, destroying the balance sheets of every sovereign nation and multinational corporation that owes money in dollars but earns revenue in a local currency.
So how does this end? How do we stop the pirate ship from sinking the entire fleet? The analysis looks back to history for a potential escape hatch, a blueprint for intervention. The Plaza Accord of 1985.
In 1984 and 1985, the U.S. dollar had gotten so incredibly strong, driven by high interest rates, that it was severely choking global trade and crushing American exporters.
The situation was very similar to the systemic pressures we're describing right now.
Very similar. The central planners of the world's major economies realized that the unchecked strength of the dollar was going to sink the entire global system if they didn't intervene.
So what do?
The finance ministers and central bank governors of the G5 nations, the US, the UK, West Germany, France, and Japan, met secretly at the Plaza Hotel in New York City.
Like a financial war room.
And they literally signed a coordinated agreement to actively intervene in the currency markets to artificially devalue the US dollar against the Japanese yen and the German mark.
They just agreed to weaken it by force. They sold dollars and bought yen and marks to manipulate the exchange rate down. So if the dollar gets too strong again today, if it starts crashing upward and breaking the world, can't they just do a Plaza Accord 2.0?
That's what people hope for.
Right. Can't the Federal Reserve and the European Central Bank just get together, print a massive, overwhelming amount of liquidity, and artificially devalue the dollar to save the system?
That is the assumption that almost every major Wall Street analyst makes. They assume the Fed can always just print more money to solve the problem. But the research introduces a powerful mechanical analogy to explain why a Plaza Accord 2.0 might be mathematically impossible today.
The bucket of water analogy.
Yes, the bucket of water.
Okay, let's visualize this. The entire global financial system is a bucket.
Right. And the central planners, the Federal Reserve, the Treasury Department, are standing above the bucket with a fire hose. When the global system seizes up, when the dollar is crashing upward and choking trade, they turn on the hose and pour water, newly printed money, quantitative easing, massive liquidity facilities into the top of the bucket.
Seems simple enough. You pour water in, the bucket fills up, the supply of dollars increases, and the dollar devalues. Problem solved, crisis averted.
But the analysis introduces a critical systemic complication that didn't exist in the same way in 1985. The Eurodollar system.
Eurodollar system. Let's
Yeah.
clarify that, because despite the name, this has nothing to do with the European currency, the euro, right? It's something much bigger and much more opaque.
Exactly. The Eurodollar system refers to the massive, completely unregulated offshore network of U.S. dollar-denominated deposits and debt that exists entirely outside the borders of the United States.
And outside the Fed's control.
Crucially, outside the regulatory jurisdiction of the Federal Reserve.
So it's a vast shadow banking system of global dollar creation. It's banks in London, Tokyo, and the Cayman Islands lending U.S. dollars to each other without the Fed ever being involved.
It is the true plumbing of the global economy. Estimates put the size of the Eurodollar market in the tens of trillions of dollars, dwarfing the domestic U.S. money supply.
Wow.
And in our bucket analogy, what is the Eurodollar system?
What is it?
It is a massive gaping hole at the very bottom of the bucket.
Oh, wow.
And this leads to the ultimate terrifying structural insight of the analysis. The question isn't whether the central planners can turn on the hose and pour water into the top of the bucket.
Because we know they can print money.
The true question is, how big is the hole at the bottom? Because as the massive global credit cycle contracts, the Eurodollar system acts as a deflationary black hole. As those offshore, unregulated debts default or are rapidly paid down in a panic, they are sucking trillions of dollars out of existence.
So the Federal Reserve is standing at the top, desperately pouring water in to save global trade, but the water is draining out the bottom into the Eurodollar black hole exponentially faster than they could possibly pump it in.
Exactly. The central banks might simply lack the mechanical capacity, the balance sheet size, or the jurisdictional reach to overwhelm the sheer staggering scale of the offshore dollar destruction.
It just can't keep up.
In a true systemic deleveraging, they might not be mathematically able to print their way out of a dollar super spike. The hole is simply too big.
We have covered an immense amount of ground today on this deep dive. We've traveled from the deceptive, paradox-like plunge in global oil prices, which masked a severe collapse in industrial demand.
A lot of hidden dangers.
Yeah, we explored the ghost cities of China's real estate market, a silent, slow-motion catastrophe, choking international bank liquidity through the invisible plumbing of dollar-denominated loans. We looked under the hood of the U.S. economy, seeing a deeply fragile foundation propped up by speculative AI capex and incredibly risky private credit. while the entire stock market balances on the precarious, mechanical tripwire of passive investing flows.
And we traced every single one of those anomalies back to the absolute bedrock of the financial system, the undeniable iPhone-like dominance of the US dollar network.
It's all connected.
A network so entrenched, so vital that it acts as a wrecking ball to the very trade partners the US relies on, forcing the dollar to crash violently upward as global debt is destroyed.
And for you, the listener, we want to make it incredibly clear that this isn't just high-level, theoretical, macroeconomic navel-gazing. This complex dynamic, the mechanical struggle between the Fed's printing press and the eurodollar black hole, it dictates the cost of your groceries at the supermarket.
Yes, it affects everything.
It dictates the interest rate on your mortgage. It determines the ultimate safety of your 401k retirement fund and the structural integrity of the company you work for. You are swimming in the bucket.
We all are. And the water level inside that bucket is what dictates the reality of our daily economic lives.
Which brings us right back to where we started today, the dashboard of the car, with the GPS showing a technological utopia and the fuel gauge spinning violently backward. It's clear that the shiny objects on the surface are hiding a deeply fragile, interconnected engine underneath.
A very fragile engine.
So I want to leave you with a final provocative thought to mull over on your own. If the hole in the bucket, that vast, opaque, offshore eurodollar system, is truly bigger than the combined printing power the world's central banks can manage, and if the US dollar continues to crash upwards, systematically starving and destroying the global trade networks like the ancient sea peoples, what happens to the fundamental concept of value itself when the system finally inevitably runs out of water?